Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen, presented in 4 minutes or less. My first blip is my opinion that Federal Reserve policy in yesterday's statement is not bullish for stocks. The key sentence from the FOMC is, tight credit conditions, the ongoing housing contraction, and elevated energy prices are likely to weigh on economic growth over the next few quarters. Tight credit conditions mean don't expect to get a mortgage at a reasonable rate anytime soon. Ongoing housing contraction means don't expect home prices to stabilize and look for more defaults and foreclosure, home builder bankruptcies, and bank failures. Elevated energy prices. The question is what's elevated relative to the 147.27 all-time high for crude oil set on July 11th. I say $75 per barrel is still elevated. These factors will weigh on economic growth over the next few quarters. We have been on a rolling next few quarters for every FOMC meeting so far this year. In other words, there is no end in sight to the great credit crunch. My second blip looks at U.S. Treasury yields, Fannie Mae spreads, and mortgage rates. There's nothing bullish here. Yields rose after the Fed decision on Tuesday. The yield on the 30-year bond is trending higher above its 200-day simple moving average at 4.519. The spread between the 10-year and corresponding Fannie Mae is 70 basis points, which is the cost of their funds. So there's been no help yet from the housing bill. The 30-year fixed-rate mortgage is 6.35% versus 5.25% in January. Treasury supply will be given a huge test today and tomorrow with auctions of 17 billion new 10-year notes and 10 billion new 30-year bonds. These auctions are probably more important than the Fed decision. My third blip looks at the topping out patterns for gold and crude oil, which have two meanings. Lower commodity prices put pressures on 300 billion investments by pension funds in commodities. Also, at some point, the correlation between lower commodities and higher stock prices will end. This occurs when stock investors realize that lower commodity prices signal global economic slowdown. COMEX gold closed below its 200-day simple moving average at 888.5 for the first time since January 2007. The 200-day held as support on August 16, 2007. NYMEX crude oil has been above its 200-day simple moving average since May 2007, and that support lags at 109.15. My fourth blip looks at the key level for the Dow following the Fed-induced rally. On June 27, we closed below the 200-week simple moving average for the first time since November 2003. This week, the 200-week is at 11,713. If we don't end the week above, then the downside risk is to annual support at 10,747. We were within 80 points of that target on July 15th. If you have any comments or questions, shoot me an email. gmcreports@aol.com. That's today's 4 in 4. Enjoy your day.